Hello value investors, thank you for joining me. Today I want to talk about irrational exuberance. So if you're new to the channel, please subscribe now so you can get my next value installment. Also, check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I tell you which stocks I own and why, with balanced arguments for the stocks I own. So let's get started. Right now in 2020, there's a large disconnect between some stocks which I will argue are in fact trading for all-time highs but are actually reasonably priced, and there are other stocks that are also trading close to all-time highs which are totally irrationally priced. So there are a few businesses that, dare I say as a value investor, are within the new paradigm, and their business model is quite different to what many traditional investors have become familiar with, and it is quite justifiable the multiples that they're priced at. Sometimes these businesses are priced as much as 10, 12, 14 times sales, and that is a reasonable multiple because the customer is so locked in. Other businesses, the vast majority of the other businesses, are trading at very similar multiples, and there's no justification for that. Particularly in advertising right now, there's many businesses in social media, etc., that are trading at very large multiples with absolutely no justification, because a lot of advertising businesses, it's quite discretionary, the customer, and the lock-in period sometimes is very, very small. So it's very, very difficult to justify certain businesses. I have no position in Pinterest, but for example, Pinterest trades for about roughly 9 times sales. So it's very, very difficult to say that this business with decelerating revenue growth rates is reasonably priced. I'm not a macroeconomist, but the economy right now, particularly in the US, a lot of investors are betting on a V-shaped recovery. Now, as a value investor, I don't try and predict the economy. As Buffett says, we don't try and predict the flow of the river, we're just trying to be fishing in the correct places. So that's again back to that circle of competence idea. And at this moment in time, it's very, very difficult to find businesses that are reasonably priced, because ultimately when the economy is not keeping pace, it's very, very difficult for those businesses to keep growing at the multiples that investors hope they will. And it's an illusion. So at this moment in time, there are some businesses that are just taking off to all-time highs, and there is no way that these businesses over the next 12 months will keep up with expectations. There's just no way. So this is what I refer to with rational pricing, rational exuberance. And on the other hand, within those businesses, there is a very logical argument for certain businesses to trade at those multiples, particularly in the software where it's asset light. It is a very reasonable multiple for them. So in conclusion, I think that it's much better for the investor to be a bit more prudent, a bit more careful, and say to themselves that whereas the S&P keeps on reaching all-time highs, I'm going to go to slightly smaller cap companies, because if you look at the Russell 2000, how it's compared over the last 2 years with the S&P, there's a very large discrepancy. Whereas the S&P is pretty much back to all-time highs already, the Russell 2000 has really not bounced back, and there is a very large gap in terms of the valuations that you see in small cap companies of what I refer to, let's say, approximately sub 20 billion market cap, and something that is above 20 billion market cap. There's this expectation that the economy is not going to be very good for those businesses, so they're really being pushed back, and there's a lot of negativity priced in to small caps, and there is absolutely no doubt, no skepticism in the very large caps. Some large caps, for example, in the case of, let's say, Apple or Microsoft, that there is a reason why those businesses trade at such high multiples, because they're very, very cash flow generative, and the business is quite recurring in a sense. If you think of Apple, Apple gets people into the ecosystem, and it's the value added products that get added on all the time. So it is a discretionary purchase, the iPhone, but that's just a funnel into the whole ecosystem. With Microsoft, there's no enterprise really that is not in some way connected up to Microsoft. So I can see those arguments, but those are very few businesses, and the rest being priced as if they are the next Microsoft, and they're not going to be the next Microsoft. So as a value investor, I honestly believe that investors will do much better cutting back on their expectations, and also it's important to look where the fish are, and I believe that in small cap stocks there are a lot of opportunities right now. So I hope you found this video useful. Don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns, and I'll tell you which stocks I own and why. I'll see you soon.